Hello and welcome to the show. I'm Kim Parlee. It is great to have you with us tonight. The final U.S. presidential debate takes place tonight, and Democratic nominee Hillary Clinton is leading in the polls, but some data suggests it's still a tight race on a popular vote standpoint in some battleground states. I sat down earlier with Michael Craig at TD Wealth to talk about how the potential outcome of the U.S. election could affect the markets, and I started by asking him if the markets have been pricing in a Clinton win.
I think the markets have priced out a lot of the risks around a Trump presidency. Certain assets like gold have underperformed over the last few weeks. So I think the markets are pricing somewhat of a no big impact. Equities are probably fairly valued, and they're looking for somewhat of a split where Clinton wins, but the lower levels of government are not democratic.
Let me ask you about, this is the Brexit question. What happens if we get a surprise outcome like Brexit? I mean, what would be first, I guess, the surprise outcomes, and then what would be the reaction?
So there's two real surprises that may occur. There's still the chance that Trump wins, and if Trump wins, right away you start looking at reduction of trade, because that's been a big plank of his policy. So that's very bad for the loonie, it's very bad for the Mexican peso, it's very bad for global trade, and I think you have a pretty severe market sell-off right away. Mm-hmm. That's becoming less and less likely as his campaign starts to implode, but it's still possible. His supporters are very, very hardened, and they will come out and vote for him on election day, so turnout really matters. Mm-hmm. The other side now that was no chance whatsoever a few weeks ago, but now is starting to become a possibility, is that the Democrats take all three levels of government. So Clinton wins the White House, the Senate goes Democratic, and the Congress also goes Democratic, which is a bit of a stretch. It's a low probability event, but it is now possible. This is going to be probably a market negative, particularly for sectors including healthcare, financials, and energy, because of some of the policies Clinton's mentioned going into this election.
And the things that she's mentioned, I mean, these are platforms she's talked about for a while, but basically these are, you were saying earlier, corporate negative. But what do you mean by that?
So more taxes, more sources of revenue, going after financials, too big to fail legislation, taxes on high-frequency trading. On the energy side, they'll be looking to raise revenues to pay for the alternative energies, less drilling permits, generally unfriendly policies towards energy companies. And on the healthcare side, really looking at reducing carried interest as well as inversion. So some of the accounting practices healthcare companies have been using to forego paying tax are going to be unwound, and that's a negative for the healthcare sector. On top of that, she may try to push through lower drug pricing, which Obamacare wasn't successful in doing, also a negative for the healthcare industry.
So let's go back to the most likely scenario with the markets are pricing in, not personal opinion, markets are pricing in, but that would be a Clinton presidency. And what about Congress? What is the likely?
Congress would stay Republican, and so it's more gridlock, which if you're looking at this from what's best for the United States, it's probably not the best result because not a lot gets done, and there's certain things that need to be addressed. But as an investor, likely the best outcome as we start looking past the election risk passes with no major impact, and we start focusing on the next item that may be affecting markets. And so ultimately this is a market positive as the risk dissipates.
If that risk dissipates and Trump doesn't win, his supporters are definitely speaking loud and clear about their disenchantment with how things are run in the United States. I asked Michael about what this tells him about the U.S. economy and what specifically he thinks is going on.
Clearly, the fruits of growth and progress are not being felt equally across not only the United States, but many Western democracies. And what it's imperative is that we start understanding that trade is good. It creates a bigger global pie of assets for all of us to consume and cheaper costs, et cetera. But there are losers from trade. And there is an important place for government to redistribute some of those gains from trade into areas that have suffered from it. Otherwise, you start paying for it through more aggressive and populist politics.
Lastly, I asked Michael what happens to the loonie in various election scenarios.
The most bearish scenario for the loonie is a Trump victory. He's been been steadfast about his angst towards trade agreements, and there's a lot of things he can do as president to really affect trade, impose tariffs, impose quotas, and it's very, very loonie negative. Easy 10% depreciation of loonie with a Trump victory. The other two scenarios, not so clear. Certainly with a kind of Clinton wins White House, it's split, and the other two levels of government, it's split, probably a loonie neutral. And then the sweep of the Democratic Party through three levels of government is probably a loonie positive, I would think, but that's not totally clear to me how that plays out, but I would be biased to be buying the loonie in that environment.
And that was Michael Craig, Senior Portfolio Manager at TD Asset Management.